Hello, I'm Robin Gibson, and this is the Harvard House Money Morsel. Welcome back. Thank you for joining us again. Don't forget to like and subscribe and click the bell so you get a notification of when we're releasing a new video. I'm sitting today with Willie Pelser. Hello, Willie. First time this year?
True, and
Yes.
the month is gone.
Yes, the month is gone. We're running into February already. So, Willie, this week we had interest rate decisions both in the US and locally. And I know Trump will be very disappointed with the US one. And a lot of the local guys might be a little bit disappointed with the local result. So, give us some sort of idea as to what was going through the central bankers' minds as to why they didn't cut rates in these last two decisions.
Yeah, Robin, I think one can one can sort of combine the fact that the US didn't and we didn't. And the easy way to answer that is actually just basic economic growth principles. I think what is happening all over the world and here in South Africa as well, we're underestimating the momentum in the underlying economy. So remember in the US or in the globe, because of tariffs and all the turmoil and stuff, everybody picture or forecast of the GDP all over the world will be lower. We're not going anywhere because of all this uncertainty, etc., etc. And same in South Africa, we're slowly picking up momentum, but no one is penciling in 2% GDP and all of those things. But the anecdotal small nuggets of data that comes out actually indicates that the economies all over the world are actually a bit stronger. So from the Fed's perspective and from the SARB's perspective, it came out in their sort of commentary and statements, is the underlying economic activity is positive. So yeah, just on that, they're waiting for stats. Remember, in the US, at some states they were closed, so all the stats are not available yet. So that's reason number one on the hesitation not to do something right now. And then if we just quickly coming back to South Africa, we've announced that we're targeting a 3% inflation rate for the economy or for South Africa. And if you look at the SARB published what they call a fan chart, or sort of a range of probabilities. So they're working with the tolerance level of around 1% on each side. So if you look at that,
So it's 2 to 4.
Effectively 2 to 4. So, but to get your target will probably take us 2 years to get there. So they did tweak their forecasts for 2026 and 2027, I think from 3.2 to 3.3 for the 26 year, and then the 27 down to like 3.1. So gives you an indication, yes, we're moving towards the 3, and also an hesitation. Just want to see the inflationary forces that's at play at the moment. We've got local issues, food and mouth, those type of things. We had all the floods in the sort of producing areas of the country. So I think they just played prudent from that perspective.
Yeah.
And that's why they hesitated. Yes, we can argue that we're not happy, but I think the Reserve Bank has proven themselves to be on the cautious side for the right reasons, not for the wrong reasons. Have we missed an opportunity? Potentially, maybe yes. One other stat that's actually positive and one would have thought it would be helpful is if you look at take-home pay. There's an index that's compiled in South Africa, and that's also on the rise, so it gives you an indication. But people are still under pressure. We see it in the retail numbers and so on. So more will come. If we do look at where we're going from a economic perspective and flow and all of those type of things, I think we can pencil in at least 1%. So that gives us,
Sure,
2 times 50 or 3 or 4 times 25. I think at some stage.
Over what sort of time period are
over
you
the
thinking?
next 18 months.
18 months.
Yeah.
Yeah.
And we mustn't forget what the rand's doing at the moment.
Yes.
The rand, obviously, there's a positive inflationary impact on the one side being, imports is cheaper, petrol price is cheaper.
Yeah. So, that was the thing I was going to raise. Really, was I know that in this last week, with all the ships gathering in the Gulf and concern around Iran, we have seen oil sort of move from the $60 a barrel up to 67.
Yeah.
But I mean, really, from a South African point of view, when you track the cost of the rand price of oil per barrel going back a year, I mean, it's almost a plummeting figure,
yes,
isn't it?
Yeah, we're positive on that. We
Yes.
are effectively lower. So yes, all of those give an indication that from an inflation perspective, yes, there's a margin that we can work probably on 1%, as I say. I don't think we will get full of it. Well, they will do the full magnitude of that, but it gives an indication that there's more to come. And I think next meeting, definitely we will, the inflationary forces won't be that negative in South Africa. And I think they will use that opportunity then to give us 25 points.
Do you think, Willie, that because they've now put this new 3% target, that this or resistance to cut now was to maintain the momentum towards that?
Yeah, definitely. I was listening this morning coming to work to an old sort of study colleague from Investec economist, and she was alluding to that factor that in the one or two members actually mentioned that. So yeah, it's definitely there.
Well, it's great to know that we might get some in the future. And I know that you watch all the inflation stats very closely and the other stats. So it's nice to hear there is some momentum happening sort of on the ground. And I think that's kind of what we're seeing. So it's really nice for investors because that should feed through into, I'm guessing, earnings and dividends down the line.
Again, yeah, we did write about it in Intuition last year. We did allude to it in our presentations, that sort of gap between the real rates, where we're heading. The bond market is telling us again since the start of this year that we're definitely moving to a lower interest rate and inflation environment.
Yeah.
So there's actual voting
with the feet. Awesome. Great, Willie. Well, thank you for giving us that insight. Thank you for joining us. Don't forget to like and subscribe, and we'll catch you next time. Bye-bye.